Learning to read candlestick charts was extremely hard for me when I was getting started until I learned this one very specific step. And once I started taking that step, it was like the water broke through the dam and finally I was able to see the charts clearly. I was able to see the patterns that I knew had the highest probability of success, and I was able to trade them with consistency and confidence. Now, what I'm going to share with you is not something that I read in a lot of the books that help teach you how to read candlestick charts. And I worry that maybe I've neglected to emphasize how important this step is in some of my previous videos, because I was just looking at a comment and one of you guys asked a question. It was on a video where I was breaking down and dissecting the anatomy of a very specific candlestick pattern. And one of you guys asked, you said, Ross, I saw this pattern in the wild, in real time on a chart, and I took the trade and it was a perfect pattern, but I lost. It didn't end up working. And I don't understand why. Can you look at the chart? And I said, oh, sure. I want to look at that because I want to understand, where was the disconnect here? Now, truth be told, even the patterns that have the highest probability of success might only work 75 to 80% of the time. So there's always going to be that margin where you've got the right idea, but the pattern just doesn't work, and that's okay. But I took a look at the chart, and they shared with me a chart of the S&P 500. And I thought right away, I was like, okay, see, here's the problem. You're trying to trade the S&P 500, and this is what I'm going to say. When I was getting started as a beginner trader, I had the idea that I should just trade the S&P 500 and I should just trade Apple every single day. I should get to know how they traded, essentially how they moved, and just trade them every day. And even though I couldn't afford to buy them outright, I was trading them using options. So I was buying calls and buying puts. And I remember a time where I pulled up my chart, and this is a chart of NVIDIA, but we could just as easily pull up Apple, or we could pull up the S&P 500. And I remember pulling up the chart and sitting here and looking at it and thinking, you know what? I don't see a thing. I don't see any obvious buy or sell signal. I don't see anything here that makes sense. Now, something that's worth noting is if you're trading large caps, you're trading the S&P 500, and you're trading options, you need fairly big moves in the value of the underlying asset in order to have a good profit, especially because a lot of options contracts have larger spreads. That's the difference between the bid and the offer. So in other words, if you're right and the stock goes up or down like 15, 20, 30 cents, that's not going to be enough to make any money on the options trade. So essentially, for me, for the way I was trading those, I was looking for big moves. And as I was sitting down on this one day, I was looking at my charts and I put my hands up in frustration because I didn't see a thing. Something that I've learned about myself is that I have a really hard time learning languages. This was something that was incredibly difficult for me in school. Other people picked it up really quickly, and for me, it was a struggle. And what I've come to realize and recognize is that learning to read candlestick charts is like learning a different language. I'll give you an example. This is a visual language in a lot of ways. So right now, I know the difference in the meaning behind each of these shapes. Each one of these communicates a different type of message to me. And the message is different depending on where these shapes occur, where they occur at the top of a move, they occur at the bottom of a move, or they occur during a period of consolidation. So I've sometimes joked that, 1,000 years from now, when stock market's obsolete, people will look back at our, Wall Street and they'll be like, what are these like? These are like hieroglyphs. What were they doing? What were they thinking? These charts that we put so much emphasis into right now. But for us, it really is a language. And so what was important for me to learn this language and to get really good at performing technical analysis, which for me in my trading really does give me an edge. I had to get good at understanding the subtle differences of when these specific shapes carry meaning and when they don't. So when we try to trade something like the S&P 500 or we're trading Apple, one of the things that I've learned is that these stocks or indices have very high levels of institutional ownership. They're also included in many different mutual funds. And so what that means is that every single day, a huge percentage of all the transactions that are going through the market are just based on institutional traders adjusting portfolios for their clients, mutual funds adjusting portfolios, buying and selling. And it's actually a very small percentage that is, I would say, organic retail traders buying and selling. And so something that's really incredible to watch in the market is that when the S&P 500 is moving down, you can look at 15 other stocks and see that they're doing actually the exact same thing. Or you'll realize that some stocks have inverse relationships. When oil goes up, airlines go down. When oil goes down, airlines go up, because they have this relationship where the price of oil affects the profitability of these airline stocks. And so once I realized that there were these sort of deeper elements at play in the market, it helped me understand why performing technical analysis on some of these stocks was so difficult. Because when you're performing your technical analysis and you're looking at your candlestick chart, this is kind of in an isolated bubble. You're looking at this very specific stock and you're like, okay, I'm looking at this bear flag, or I'm looking at this flat bottom breakdown, or this flat top breakout, or whatever the case might be. But to take it out of the context of what's happening in the larger market, so on and so forth, you may end up taking a trade, and then all of a sudden at 1 p.m. there's a Federal Reserve announcement, and boom, all of a sudden the stock starts making this huge move, and it was unexpected for you because you were too tunnel vision, you were too zoomed in. So this is what I learned. Reading candlestick charts for me got easier once I realized the type of stocks that I made the most money on. This comes back to stock selection. So to reduce our risk in trading, recognizing that, of course, trading is risky, I've learned that I can reduce my risk by focusing on the right stocks to trade. When I try to focus on trading Apple, Microsoft, Nvidia, these stocks with huge percentages of institutional ownership, I get chopped out by the algorithm and just by the position adjustment of these big portfolios moving in and moving out of the market. You might have one client who said, liquidate a $500 million portfolio. I want to go buy a yacht or whatever. And now their portfolio manager is like, okay, I got to start selling. They start selling, and all of a sudden that's creating these big candle wicks on the chart. And you're like, why is this happening? I don't understand it. And it's happening just because of something that's completely out of your control. Now, I'm actually going to put a link for a PDF in the comments. It'll be pinned to the top of the comments, and it'll be linked in the description. It's a PDF for my stock selection criteria. And you can download this, and I encourage you to download it. You can print it out. You can have it on your desk. And when you hear somebody talking about a stock, or you're seeing something that's popping up, you're seeing it on the scanners, or however you're coming across it, run that by that checklist and ask yourself, how closely does this meet the criteria that Ross has set up? Now, of course, it's the criteria that I use, but this is what I look for in order to consider if something is worth trading. I feel like this, for me, helps me reduce my risk because it helps me avoid stocks that are more likely to have a high degree of institutional ownership, are more likely to cause me to get chopped out, where I'm going to get frustrated and then emotional, have unnecessary losses. So download this stock selection criteria PDF. You can print it out, have it next to your desk, and just use this kind of a reference to gut check. Like, am I focusing on the right stuff each day? So what is the right type of stock to trade? For me, I'm a volatility trader, which means that I make money trading things that move. I don't make money buying something at $5 and selling it at $5. I make money buying something at $5 and selling it at 8, 9, 10 or higher. And if I could do that in one day, I'm going to be very happy. Now, today we had a few examples of stocks that made those kind of moves. ZAPP was one of them. This stock went up about 180% this morning. And so you can see this pattern right here. Now, this right here was bucking the trend of the overall market. And this is a 5-minute chart, but we can zoom in on the 1-minute chart to get a little bit more dialed in, and I can show you my exact entry. So this was bucking the trend of the overall market. The overall market today was actually pulling back a little bit, but this is a stock that had a catalyst. This is a stock that had a reason to make a big move. And because of that news catalyst, it had volume, it had volatility, it had the rate of change that I look for, and I was able to capture profit. So to put my money where my mouth is, you can see I'm up $6,416.40 trading ZAPP. Now, I'm not going to be green every single day, and I'm not going to be green on every single stock I trade. So I want you to understand that when I'm teaching you some of these patterns that I really like, even me with years of experience, there's no such thing as being right 100% of the time. That doesn't exist in trading. I know a lot of you look for that certainty. You want to be right 100% of the time. You never want to lose. And I get it because I was like that too when I got started. It actually sent me on what I would call the hunt for the holy grail. I was looking for the perfect combination of technical indicators that would basically guarantee I would never lose money. And after spending years searching, I realized it doesn't exist. Not for retail traders like you and I. The people who make money every day, maybe are the brokers, right? But not retail traders. We have to fight it out. We're on the ground floor here. We're in the weeds. But if we find a pattern that works more often than it doesn't, and we're able to keep our losses really small, we can develop an edge in the market. And that's exactly what I've been able to do. So let's talk about the criteria for the right stock to trade. Because in terms of setting a foundation for success as a trader, number one, you've got to understand risk management. And risk management to me is at its base, understanding that you should never risk more than you stand to gain as a trader. So if you're going to risk 1,000, you better have the potential to make at least 1,000, if not 2,000 or 3,000. That alone can save you all kinds of heartache and frustration. Because I can't tell you the number of traders who have come to me and they say, oh, I lost $5,000 on this trade. And I'll say, well, what was your stop? What was your max loss when you took the trade? And what was the most that you could have made if it worked out well? And not being like unrealistic, but like realistic expectations. How much did you stand to gain? And they'll be like, oh, well, when you put it that way, only like $1,500, but they lost $5,000, right? So totally mismanaging their risk. So if you can understand, number one, that in trading, never risk more than you can stand to gain. That's step one. All right, so we want to have 1-to-1 profit to loss ratio, and minimum is 50% accuracy in order to be break even. Anything above that is going to be positive. Number two, stock selection. And then number three is the technical analysis, right? It's technical analysis of actually reading the candlestick charts, right? So number two, stock selection. For me, what I found, and this is based on years of my own trading data. So I've gone through all of my data and I can share it with you here just really briefly, just to kind of give you a sense of how much data we're looking at. So if we step back here, this is going to be, oh, let's see. We're going to clear this out. I'm going to have about $11.2 million in gross profit here. Now, I'll say right now, my results are not typical. You shouldn't assume that you're going to make the same amount as me, but this is important to learn from someone who's proven profitable. I have this track record and it is real money. So with $11.2 million of profit, let's look for a second at price and volume. So this is telling you the price stocks where I make the most money, right? So, okay, so all right, so we're trading between $2 generally and 50. And you can see the sweet spot for me is really between 2 and 20. That's the spot where I make the most money. So let's start sort of outlining this as stock selection. Number one, price. So we're going to do price, and we'll flip it over to this side here. We'll start fresh. All right, so stock selection. So number one, price between 2 and 20. That's my sweet spot. Now, I'm not saying that I don't make money when I trade stocks that are a little more expensive or a little cheaper, but this is my sweet spot between 2 and 20 where I do the best. As a beginner, it seems to me that it would make sense to focus on the sweet spot where other traders are doing their very best, rather than trading sort of the edges of where they find success, right? So number one, price between 2 and 20. All right, now something that's very interesting here, we can look at instrument, and we're going to scroll down here. When this loads, we're going to look at performance by instrument relative volume. And what you'll see here is that the performance by the instrument relative volume, it's very clear right down here. So what does this mean? What this means is that the majority of my profit is on stocks that have 500 times higher volume today than their 50-day average. That means today they have high volume relative to normal. What's the cause of high volume? Typically a catalyst. So let's start plugging this in. All right, number two, 5 times relative volume. This is a measurement that we can get from scanners. Number three, news catalyst. All right, number 4. All right, so we're going to go to number 4 here. And if we scroll down here, what we're going to see is that performance by instrument movement and performance by opening gap. The majority of the profit is when stocks are gapping up at least 2%. Gapping up means moving higher than they closed the previous day. So up 10%. So if I just apply these 4 things right here, these are going to eliminate how many losers? Thousands and thousands of losing trades. I can completely eliminate. I'm not even going to consider it. If the stock doesn't fit within my price range with the relative volume up at least 5% on the day, I prefer 10% or higher, I'm not even going to trade it. So the S&P 500, no trade. Apple, no trade. Nvidia, on most days, no trades. Now, I'm not saying that there aren't exceptions to this rule. There are going to be days when Nvidia has news and makes a huge move, and it's worthwhile considering. There's days where Apple has news and it's worth considering. Those are days where the price is outside my focus area, but it's got the relative volume, it's got the news catalyst. Maybe it's not up 10%, but it's up 4 or 5%. And for a large cap stock, all of that could support considering an entry. Now, one of the 5th things that I look at is float under 20 million shares. And lower is better. Float is the number of shares available to trade. So when a company does their initial public offering, they sell shares onto the open market. From that point forward, that's the float. So what we've actually done here is we've just created a list of demand and supply, also known as supply and demand. So now let's think about this for a second. So we've got demand right here, and demand initially is created first by news, then by the stock going up 10%, which then will bring in 5 times relative volume, right? All of a sudden now it's moving. And usually stocks between 2 and 20 are going to show bigger percentage returns. Supply, this is the number of shares available to trade. So let's say the float is 20 million shares. And let's say on this particular day, the stock has 100 million shares of volume. So 100 million shares of demand versus 20 million shares of supply, what do you think is going to happen? You're going to have a huge move. That's what we like to see. So now let's go back and look at this stock today that I traded. So we're going to pull back this graph right here. I'm going to move that out of the way. So ZAP, Z-A-P-P, this has a float of 4.29 million shares. That's the amount of shares available to trade, 4.29 million. This is a relatively small cap company, right? The total market cap of this company, 4 million times $3 a share. So this is not a high price company in terms of market cap. Today, it traded an incredible 91 million shares of volume. Now, I always think that this is pretty amazing because, in fact, today, it traded the entire market cap, the entire float, traded multiple times. People bought, people sold, people bought, people sold. This traded, well, nearly, let's see, $300 million of stock traded hands. Why did it cycle so quickly? Because we had news. We have news, we have the percentage return. That brings in the volume. What really starts all of this, the chicken or the egg, it begins with a news catalyst. You get the news catalyst that comes out, and you have these high frequency trading algorithms that respond to news instantaneously. They instantaneously execute buy orders. And when other algorithms see this surge of buy orders coming in, they pull their orders off the market because they don't want to accidentally short a stock that's suddenly spiking up. And without those sell orders holding it down, all of a sudden the stock starts squeezing. So something that's kind of interesting is that there's a misconception that high frequency trading algorithms create liquidity in the market. They do, but not when the market becomes volatile. Because when the market gets volatile, they step back because they don't want to lose money. So they turn off. All those buy and sell orders are gone. And so now the sell orders that would have created a level of supply, overhead supply, they're gone. And now the price can skyrocket. And that's what we've seen. In fact, I've seen stocks that have gone from $2 to $15, $25 in a matter of 15 minutes, which is absolutely incredible when it happens. Now, in order to fully capitalize on those types of stocks, no doubt you need to be an expert at number 3, technical analysis, right? Step 1, understanding risk. Step 2 is stock selection. Step 3 is technical analysis. Now, by the way, if you want to download my stock selection PDF, I'm going to put the PDF, it's a PDF that you can download. I'm going to put the link in the description and I'm going to pin it to the top of the comments. So this is going to break down my criteria for buying a stock, the demand and the supply, and it's going to make it, it puts it in a nice format so you can download it, you can print it out, and you can put it right next to your desk. I really encourage you to do that because in my opinion, in order to have success, you need to be trading the right stuff. And this is the biggest mistake. So that member or that subscriber that made that comment about the stock that they were looking at, it was S&P 500. And I was like, well, you know, but here's the problem. You're trying to trade something that's range bound. It's not moving. And no wonder you're going to get chopped up. You know what? The pattern you saw, that big green candle that created the bull flag, that could have just been one institutional trader executing an order for a client. There wasn't a catalyst behind it that carries meaning. So what I mean by that is when we're looking at a stock that has the potential to make a big move, you know, I'll just sort of go like this. Why is a stock going to go up 15, 20% like that? I'll do it in a different color so it's easier to read. Why is a stock going to make a big move like this? You know, one initial pop and then back down, it's a catalyst. Why are people going to buy this pullback? Because when we're looking at a bull flag, we're looking at green candles up, up, up. And then we look at the red candle pulling back right here, red candle pulling back. And then we look for the next candle to come in for the next leg up. But why are people going to buy for that next leg up? They're not going to buy for that next leg up if they don't think this has the potential to make a big move. What gives it the potential for that big move is when you have the news catalyst. Now, I will say that there are some exceptions to this. You can, for instance, have a stock that suddenly, and we don't always know why, squeezes up 25, 30% or 40%, something like that. It makes a huge move. Now, it could be because an institutional trader decided to take a position, but they took such a big position that they moved the stock up 30%. Okay, so now suddenly we're looking at the stock and it's up 30%. And we're like, well, geez, this meets our criteria. It doesn't have news, but it's up 30%. It already has 5 times relative volume. It's the right price and the float's right. So the absence of news in this case, I can tolerate it as long as we have everything else. So there are times where I'll take those trades. And at that, when that's the case, I'm doing the same level of technical analysis. I'm pulling up the chart and I'm saying, okay, well, where's the pullback? So if we look at this, I'm actually going to zoom in on this micro time frame here. So on Zap, this had an amazing little micro pullback right at $2.50. It was an ascending wedge right here. So that was the spot. And see how this was ascending support? So what I often will do is I'll actually draw this kind of ascending support trend line like this. And then we've got this flat top right here, right underneath the psychological resistance of the $0.50. And it finally pushes away. And this thing squeezes from 250 straight up to 3. Halts up because it's so volatile. It opens, it pushes even higher. And next thing you know, we're hitting a high of 380. But notice this candle right here. So what do we know about that candle? See, now this is where we're applying what we're learning about the language of technical analysis. We know that this candle has a very tall upper candle wick. So how are upper candle wicks created? An upper candle wick is created when the price, and I'm just gonna use this orange just because it's the quickest to grab. So the price squeezes up, and if it closed at the high, you've got a very bullish candle. Price is going up, right? But if it squeezes up and then the sellers push it back down and it closes like this, that shows that sellers were in control. So now in this moment, the sentiment is weak. Now I know how to read that candle. I know what this topping tail means. This is bearish. Bearish, weak, not good if you're long. Now the opposite of a bottoming tail. A bottoming tail is bullish and is strong. We usually like to see that. So in any case, as I saw that topping tail candle, I thought, all right, well, that's not great to see. This is probably going to be the high a day, but it may come back up and retest it and form a double top. That's a double top right there. This was potentially going to form a cup and handle pattern for a move higher, but it didn't. Now, all of this technical analysis is worth performing because we're looking at something that has volatility. We're looking at something that's moving. That's what's important. So if we look at some of the other stocks today that were volatile, this was ZAPP, ALUR. This is one that's currently up 136%. We back this chart out here, and you're going to see again, this is the type of thing that you want to be looking at. You want to look at these candles. You want to look at them at the 1 minute. You want to look at them on the 10-second. Look at it on the 5 minute. Check the daily. When you have something that goes between $1.20 and $3.50, there's a lot of opportunity here. Even if you only capture a little sliver of it, getting in at $2.30 and selling at $2.50 or $2.60, a little sliver of this huge move, that's a 10% return right there. You're not going to get 10% returns trying to day trade Apple or Nvidia or the S&P 500. Again, unless you're trading options and it's a day where the price is particularly volatile, but that's not the case on most days. So one of the things for me that was really helped me have a breakthrough was the realization that focusing exclusively on technical analysis without thinking about the right type of stock to trade was resulting in me getting chopped out and losing money. I was losing money. I was struggling. Once I realized the type of stocks that had the biggest moves were the ones I was making the most money on, I decided to only perform technical analysis on those. I left everything else behind. And guess what? Things started to improve. I started seeing stocks that were going up 30, 40, 50%. And even though I was only capturing a little piece of that move, 10 cents here, 15 cents there, boom, with 1,000 shares, it's $150. Another $150. Now I'm up 200 on the day. That was my daily goal when I was getting started. And I found it was a lot easier to hit my $200 daily goal when I was trading stocks going up 40, 50, 100% than by trying to trade things that are going sideways. So if you're someone who's been trading cryptocurrency, you'll know that trading the ones that are the most volatile is where you're going to find success. You trade cryptocurrencies like Bitcoin, volatile, but a lot of chop. Very difficult to perform technical analysis. You want to trade Forex? Some currency pairs are going to be more volatile than others. You want to trade futures? There are certain days of the week, certain weeks, days out of the month where individual future contracts are going to be more volatile than others. As active traders, we hunt for volatility, but we have to be managers of risk. So at the end of the day, I'm thinking about my risk, and I feel like I reduce my risk as a trader by only trading things that are moving. When I get bored and I start looking at Tesla or Nvidia, because while they're moving in dollars per share, the percentage, it's not there. And that's when I end up struggling. That's when I end up getting chopped up. That's when I end up losing money. So the big lesson that made reading candlestick charts a lot easier for me was recognizing the right type of things to trade. For me, it's stocks. So I hope you download my stock selection PDF. It's going to break down the type of stocks that I like to trade every single day. And I think if you set this as sort of part of your foundation, practice trading these in a simulator, see what happens. I think you'll be impressed. Now, as always, I'll remind you, trading is risky and my results aren't typical, so take it slow. And look, if you enjoyed this episode, I hope you hit that thumbs up. I hope you subscribe, and I'll see you for the next upload real soon.